Hello friends, hope you're doing well. Chris Lee CPA here, back with another year-end 2025 tax strategies video. And today we're going to talk about crypto and tax strategies for crypto investors. So some of these concepts will be similar to what you see for stock portfolios, but there are a couple of nuances that are relevant to crypto investors, which actually make them slightly more tax efficient. So we're going to talk about those strategies and how you can use those to reduce 2025 crypto taxes, and then also consider, future taxes on crypto transactions. So the first thing we want to talk about is harvesting losses in your crypto portfolio. So even though we're seeing Bitcoin, at all-time highs, you may not have that experience in all of your crypto portfolios. So some of your crypto investments might actually be experiencing some unrealized losses. So what we need to think about is that we can use losses from our crypto portfolio, which generate capital gains. So in this context, I will say that pretty much all crypto investors, unless you are considered a day trader and on the mark-to-market method of accounting, you are often going to be generating capital gains and losses. So the general concepts that we know about capital gains and losses generally apply to crypto. So with that said, we might have some coins with some unrealized gains built in, and then others with unrealized losses. And what that is to say is that what we originally paid for it, the value might be higher or lower, and we just haven't sold off that transaction. And when we say sell in crypto, we really mean trade that from one coin to another. That's what locks in the transaction. A lot of times what I see, particularly with newer crypto investors, is that they think sale means I liquidated my coins for cash, like USD, into a bank account, like a traditional bank account. And that unfortunately is not the case. When you trade one coin for another, that is a taxable transaction. Some like to think like, oh, I didn't get cash out of the transaction, so that's not a gain or loss. No, that's not the case. That fundamentally is kind of like thinking, oh, it's a like-kind exchange. It didn't actually do anything. Unfortunately, like-kind exchanges only apply to real estate. They don't apply to crypto. Crypto is considered property for tax purposes, not a security, but even with the property, it's not considered real estate. So that's the framework. Now going back to kind of our first strategy of harvesting your losses. If you have a security that you bought previously, or not a security, crypto, because crypto and securities are different. They're not exactly the same thing. But if you have crypto that you bought, maybe let's just say the reference value is $10,000 and now it's worth $7,500, you have an unrealized loss. Well, if we want to actually get that loss realized, we can go ahead and trade that for USDC or some other crypto and trigger that loss when we actually dispose of it, relinquish control. And the consequence there is we can use that loss to offset gains of other cryptocurrency, but we can also use it to offset gains that might be occurring maybe in our stock portfolio. So that's the magic here, is we can use losses from our capital losses from our crypto to generate some offsets that can reduce the gains amongst our other crypto transactions or our security transactions or our stock transactions. So when it comes to losses, we just need to remember that short-term losses offset short-term gains first, and then we have long-term losses that offset long-term gain first. And then we can offset any net gain or loss from the long-term bucket and the short-term bucket against each other. Now, so there are some mechanisms of how this is going to work. You can't just inherently use a long-term loss to offset short-term gains. Like, there are some mechanisms in there, but fundamentally what we want to do is, if we can get long-term losses to offset short-term gains, that's the best scenario that we can win with, is because long-term gains are taxed at a lower tax rate than short-term gains. So that's fundamentally what we're trying to do, is reduce the tax consequences on our short-term gains. If you do generate losses for the year, excess losses over $3,000, those will be carried forward because we can only use $3,000 to offset other ordinary income. Now, one thing that is really special about crypto, and this is direct crypto holdings only, is that they are not subject to the wash sale rules like a traditional stock security would be. What the wash sale rule says is that you can't claim a capital loss when you repurchase the same or a substantially identical security within 30 days before or after the sale of that asset that created the loss. So what that is to say, though, is that the wash sale rule only applies to securities. Crypto is not a security, it is property. That is how the IRS treats it. So that means you could say as of 12/31/2025, sell off crypto that has maybe an unrealized loss of $5,000. And then just on the next day, repurchase that same crypto asset. And, you basically have an identical position, but all you did was lock in the loss. So there would be no need to wait for 30 days after the sale to repurchase to avoid the wash sale rule, because the wash sale rule is not going to apply. So that really is the magic of crypto, is the capacity to be able to generate a loss and be able to lock it in no matter what, that you don't have to worry about what happens maybe on the other side of the year. So if we were doing this with a security, if we sold on 12/31/2025, had a $5,000 loss, we'd have to wait till February of 2026 to rebuy that security. Otherwise, the wash sale rules would apply and block that loss from being realized on our 2025 tax return. And with most of the brokerage houses, they're tracking all of that for securities. When you're on Coinbase, though, or something, and you're holding securities directly, you're not securities, crypto. See, it's really easy to get those terms mixed up. But when you're holding them directly through a Coinbase account, or if you've got them in cold storage or something, those wash sale rules don't apply, because crypto is treated as property. So that's like the one special rule, is if we know we've got some, maybe even have like a windfall capital gain coming in, and we can see some larger unrealized losses in our crypto portfolio of assets that maybe we don't want to like permanently get rid of. But what we can do, trade them off, lock in that loss, and then repurchase them like immediately. And you've really not changed your position in your crypto portfolio, but you can generate a big loss potentially, offset your huge windfall gain, and manage your taxes for the year. So that's like the secret sauce of tax loss harvesting when it comes to your crypto portfolio. Just remember, though, that your crypto portfolio tax loss harvesting is going to be also compounded with whatever tax loss harvesting you might be doing with your self-managed security portfolio. And then usually a financial advisor is also going to be, and that is if you're doing some tax loss harvesting in your self-managed portfolio. And then if you've got funds with a financial advisor, usually they're doing some tax loss harvesting. So just make sure you're not overdoing it, that you're generating all of these excess losses in excess of that annual $3,000 limit that are going to be carried forward. That's like the biggest thing, is like people, when they first learn about tax loss harvesting, they get real gung-ho about it. And then what they end up doing is overdoing it. And then they end up with too many losses that go unused for several years. So don't overdo it. One thing to also add is, now that we've got widespread adoption of some crypto ETFs are not the same as directly held as crypto. They are actually, crypto ETFs are treated as security, so the wash sale rules will apply, which is unlike if you hold crypto directly through maybe like a Coinbase account or something. So that's like a thing to remember there. The next thing that we want to talk about is potentially, rather than harvesting losses, we actually harvest gains. So usually we harvest gains when we know that we're in like a lower tax bracket for the year, and that we think we're going to be in a higher tax bracket in future years. So what we do when we are executing that is we are going to be having a gain that we're choosing to be taxed at a lower tax rate currently. So, and then the consequence is we get a higher basis on the other side of that. So we sell off the crypto, recognize that gain at a tax rate that we're comfortable with, and then we can rebuy the asset on the other side. The good news when it comes to harvesting gains is there's nothing that says, there's no wash sale rule, both for when it comes to harvesting gains. So that rule applies to both crypto and your standard security. So you can just harvest gains at a tax rate that you feel comfortable with and get that higher basis, and go forward from there. So an example of this would be, say you bought Bitcoin a few years ago at $20,000, and now that Bitcoin is worth $100,000. And so that's an $80,000, capital gain that you've got built into there, that if you were to go ahead and trigger that gain, it'd be taxed at 15%. And that's a pretty low tax rate. So you can go ahead and trigger that gain. And then what happens is you can use those proceeds, that $100,000 you obtained from the sale transaction, and then rebuy those shares on the other side. And now you've got your same amount of Bitcoin at $100,000 basis, such that maybe in a future tax year that would be taxed at 23.8%, rather than having a lot of gain, that $80,000, and future tax years being taxed at maybe a 23.8% tax rate. We've locked in some of it at a 15% tax rate. So the most important thing, though, is that if you're going to harvest gains, you want to do that on your long-term capital gains. You don't want to do it on your short-term capital gains. Short-term capital gains are for crypto. You hold for 1 year or less, you'll pay ordinary income tax rates on that. You want to harvest gains on your long-term capital assets. So that's the most important thing when you talk about harvesting gains. Harvest long-term gains and go from there. So the next thing we can talk about is similar to when we donate from our stock portfolio to avoid capital gains. We can donate our crypto as well to avoid maybe some unrealized appreciation. In tax, when we say the word unrealized, it means it has a value that's higher than what we paid for it. We just haven't realized that value by having a sale transaction. So when you're charitably inclined and you're going to be itemizing your deductions, you can donate appreciated assets, usually securities or crypto, to charity to basically avoid the capital gain on that appreciated asset. And then you can also attain a charitable contribution deduction at the value at the crypto at the time of the donation. So say, let's revisit that $100,000 crypto. Maybe we are going to give $100,000 to charity anyway. And rather than give $100,000 cash or sell off a stock security and trigger some sort of gain, we can actually donate the crypto, maybe Bitcoin, directly to the charity. And what happens is you get a charitable deduction for that, say, $100,000 that you paid $20,000 for. You get a $100,000 charitable contribution deduction, and you don't pay the gain on that that's built into that asset. You paid 20 for it, you donated it at 100, that $80,000 gain goes untaxed. Now, the issues that can occur when you're trying to donate crypto is the capacity for a charity to receive crypto. That sometimes becomes the problem. It's just the logistics of that. So more and more charities are, in a position to accept transactions. And what you'll see, oftentimes what you'll do this through also is you can do it through a donor advised fund. So donor advised funds are specialized accounts that basically support charitable organizations. And when you donate to the fund that you self-direct where the resources go, you'll get the charitable deduction when you donate to that donor advised fund. The donor advised funds come through some of the larger brokerage houses, like even Fidelity Charitable, and like Fidelity Charitable can accept crypto donations. So that's the big thing there. So yeah, that's one thing to think about. The last thing I will say when you're donating crypto is that they can only amount to 30% of your adjusted gross income. If it exceeds 30% of your adjusted gross income, it will carry forward the excess to future tax years. So the benefit isn't completely lost, but it will be on the other side of the year, or you'll be able to claim it in future tax years. So one thing to also remember is that when you donate crypto because it's property, it's going to be considered a non-cash charitable contribution. You'll have some specialized reporting. So just be aware that there's going to be some extra forms you'll have to fill out with the IRS to say, this is what I donated, this is what I bought it for, this is the fair market value on the date of the donation, the organization's name, all those sorts of things. So you'll have some extra reporting, but it's worth it just to claim that larger tax benefit. If you're thinking that you're going to be supporting, a child or grandchild or spouse or another loved one for the year, you could consider crypto. So what this basically does is, rather than selling off your crypto and giving cash, you can gift it to someone that you're going to be supporting. You can give gifts, non-taxable gifts. So gifts are never taxable to the person receiving the gift. They could potentially be taxable to the person giving the gift. And so there is, in 2025, gifts up to $19,000 to an unlimited number of people without triggering any tax or reporting obligation for the recipients. If you're married, you can do something called gift splitting, and you can combine donate $38,000 per recipient. So that's what you can do when you donate that. Also, is you're sending that maybe some built-in appreciation on your crypto to another person that might be in a lower tax bracket. So that's the nice thing about it. is that you might end up being able to avoid some capital gains on that on a sale transaction of that property in the future. So the last thing that we can talk about is maybe doing some crypto investing in a self-directed IRA or 401k. So typical IRA and 401k accounts are not going to have capacity to do crypto investing. But if you have a self-directed account, oftentimes you'll see that. The reason these are so slightly more efficient is because you can do intertrading you can do trades within the crypto assets that you hold in those accounts without triggering gains or losses directly on your tax return. So the transactions that occur in that account year over year don't get taxed. It's when you take the distribution out of those accounts, whether as a required minimum distribution or as a standard distribution, those will be taxed the value of what you're taking out of that account. So that's a really big benefit there that people that are heavy into crypto investing, they're generating a lot of short-term gains, but they're not really like liquidating those assets for like living on. This is something, if they have an option for a self-directed IRA or solo 401k, that we'll talk about, because it's much more tax efficient, and getting kind of like a day trader tax status is a little bit more challenging than some people would realize. And so our alternative to that is, if there is capacity for a solo 401k or a self-directed IRA, that we will see that. So key takeaways for this, as you're thinking about wrapping up your tax year 2025 and you're thinking about any crypto profits, if you have crypto that has declined in value, sell it before year end to realize the capital loss. Any excess of $3,000 will carry forward. If you're in a lower tax bracket this year and you think you'll be in a higher tax bracket in future years, go ahead and sell off appreciated crypto, realizing your gains, and then repurchasing that position. The result is you'll get a tax basis on your crypto asset at the price that you buy it at. The next is, to summarize, item 3, donate your appreciated crypto. This lets you deduct the value of the crypto at the fair market value on your charitable donation as an itemized deduction without having to recognize the capital gain. Just know that you don't want to donate a depreciated crypto asset. You want to donate appreciated, because if it was depreciated, you'd be better to just sell it, recognize the capital loss, and then give the funds over. But the appreciated asset, go for it. Consider gifting crypto to loved ones. This lets you potentially shift the consequences of that gain to someone that either has a 0% tax rate on capital gains or no tax, or at least a lower tax rate than you would otherwise experience. And then if you're making regular trades or trying to think about a more tax advantaged way to work with crypto, consider establishing a self-directed IRA or solo 401k to work through these items. Basically, it lets you do all your trades without triggering current tax consequences, because only the distributions out of those tax advantaged retirement accounts will be taxable. So with that, there will be a link to my calendar if you choose to, talk about these things more directly or want some specific advice. You can book a time to call and we can chat directly. So otherwise, have a new video for you soon. Talk soon. Bye.